Late fees and penalty APRs. Card issuers treat a minimum payment miss as an instant revenue opportunity, charging a fee that far exceeds the real cost of collection. Missing a due date immediately posts a late fee and can strip your interest-free grace period on new purchases, meaning new debt accrues interest immediately. Repeated late marks trigger a penalty APR, often near 30%, which applies to existing and future balances, making carrying debt significantly more expensive. Since interest compounds daily, the combination of a fee and higher APR quickly snowballs. Issuers intentionally keep the minimum payment low, 1 to 2% of the balance, to maximize long-term interest. A single late incident can also trigger internal consequences like a trimmed credit limit, disappearance of promotional offers, and a worsened internal risk score, justifying more aggressive pricing. While regulators in countries like the UK have capped these fees, in the US caps face legal challenges. The system is fundamentally a pricing mechanism designed to turn minor lateness into long-term profit through escalating penalties. Compounding interest and revolving balances. The main profit source for credit card companies is the revolving balance. When any unpaid portion is carried over, interest compounds daily, not monthly, meaning you're paying interest on the interest. A typical 24% annual percentage rate, APR, translates to roughly 0.066% growth every single day, quietly overwhelming small minimum payments. Issuers use practices like two-cycle billing or trailing interest, which cause interest to accrue between your statement date and the payment date. This subtle timing ensures interest appears even if you pay the full balance, harvesting extra days of interest legally. Another major trap is deferred interest promotions, e.g. 0% if paid in full within 12 months. If the balance isn't fully cleared by the deadline, the borrower is charged retroactive interest on the entire original amount, nullifying the promotional period. Furthermore, most cards have variable rate structures tied to market benchmarks. When central banks raise rates, issuers adjust quickly, but when rates fall, reductions are slower, ensuring stable yields for the lender. Minimum payment illusion. The minimum payment listed on a credit card statement is a deceptive relief valve, engineered to ensure slow, expensive repayment. Calculated as a tiny fraction of the balance, 1 to 3% plus interest, it barely covers finance charges, leaving the principal virtually untouched. For example, on a $5,000 balance at 20% APR, paying only the minimum could stretch repayment beyond 25 years and significantly increase the total cost. This design is intentional. Keeping payments low reduces delinquency rates and keeps borrowers trapped in the profitable revolving system. Psychologically, the minimum payment creates a false sense of safety, masking the long-term quicksand of debt. Statement designs and digital interfaces consistently highlight the smallest number, nudging users away from paying the full balance, which translates into billions of extra interest income annually for the banks. Some issuers even use balance recalibration, temporarily lowering the minimum requirement after a large payment, which makes the remaining debt linger longer. The minimum payment is the core mechanism for sustaining debt while maintaining a borrower's sense of forward progress. Payment allocation and grace period games. The sequence in which payments are applied when a borrower carries multiple balances, purchases, cash advances, promotional transfers, is a key profit lever. Historically, issuers maximized revenue by applying payments to the lowest interest balance first, letting costly high APR portions compound faster. Though regulations in many regions now require payments beyond the minimum to be applied to the highest rate debt, issuers still find subtle workarounds, such as redefining what constitutes a promotional balance, or using timing distinctions between posted and pending transactions to delay interest reduction. A critical related tactic is the grace period reset. If you revolve any portion of your balance, the interest-free grace period on all future purchases vanishes. These new purchases immediately accrue interest from the transaction date until you pay off the entire amount owed, effectively removing your interest shield. Some cards further segment balances into micro categories, each with different rates and rules. This financial choreography makes the debt structure complex, ensuring the math always favors the bank. Reward programs and behavioral conditioning. Credit card reward programs, cashback, miles, points, are not generosity. They are sophisticated behavioral conditioning systems designed to maximize spending and benefit the issuer. The small 1% reward you earn is bait, dwarfed by the 15 to 25 times greater revenue the bank earns through interest and merchant fees. Reward currencies are intentionally opaque and controlled by the issuer. Points lack stable value and can be silently devalued through program realignments, yet consumers continue to chase status tiers and arbitrary spending thresholds. Partnerships further lock users in. Airlines and retailers sell loyalty points to issuers, making card spending the primary goal for the partner. The psychology is powerful, using colorful dashboards and time-limited bonuses to tap into the brain's variable reward circuitry, similar to gambling addiction. Users are conditioned to swipe more and carry balances longer, increasing the bank's profitability. The rewards are the leash that keeps the user tethered to a high-yield revolving credit product. Balance transfer and promotional rate traps. Balance transfer promotions offering 0% APR are attractive on the surface, but are often hidden debt traps. Most transfers involve an immediate upfront fee of 3 to 5% of the transferred amount. Crucially, if the borrower fails to pay off the entire balance before the promotional window expires, the remaining debt reverts to the standard high APR, which is frequently applied retroactively to the original transferred amount, effectively cancelling the 0% period. The promotional clock often starts immediately upon approval, shortening the true 0% window. Furthermore, a single late payment can immediately forfeit the entire promotional rate, applying the standard high interest rate to the whole remaining balance. Payment allocation is also obscured. Payments often go toward the 0% transfer first, while any new purchases made on the card quietly accrue interest at the high regular rate. This delayed interest structure relies on human forgetfulness, ensuring that issuers eventually harvest higher interest on remaining balances. Cash advances and quasi-cash transactions. A cash advance is one of the most expensive ways to use a credit card. These transactions carry separate higher interest rates, typically 25 to 35%, and unlike purchases, they start accruing interest immediately. There is no grace period whatsoever. On top of this immediate interest, a separate cash advance fee, usually a percentage or flat rate, is charged. Because the cash advance balance is often segregated from purchases, monthly payments may be applied to lower rate purchases first, allowing the high interest cash advance debt to linger and compound. Issuers also exploit this mechanism using quasi-cash transactions. Items like lottery tickets, gambling chips, or specific crypto purchases are quietly coded by the bank as cash equivalent, triggering the higher cash advance rate and immediate loss of the grace period without the user's explicit knowledge. For international use, these transactions also incur extra conversion charges and network fees, making this option exceptionally costly. Foreign transaction fees and currency conversion manipulation. Every time a card is used abroad, the issuer and card network quietly collect a toll through the foreign transaction fee, typically 2 to 3% of the purchase amount. This charge is mostly pure profit, as the actual cost of currency conversion is minimal. A more aggressive tactic is dynamic currency conversion (DCC). When offered the option to pay in your home currency, the exchange rate is set by the merchant or processor, resulting in a rate that is usually 3 to 8% worse than the official bank rate. The merchant receives a commission for this deceptive practice, and the card issuer may even add its own foreign transaction fee on top of the inflated exchange rate. Even online purchases on domestic-looking websites can trigger hidden international charges if the processor is located overseas. Premium cards advertising no foreign transaction fees often compensate through higher annual fees or embedded exchange markups elsewhere. This system acts as a global micro-tax on cross-border spending. Credit limits, utilization, and over-limit fees. Credit limits are actively managed by card issuers to generate revenue and control user behavior. Historically, issuers charged an over-limit fee after automatically approving transactions that exceeded the customer's cap. While regulations now require explicit customer consent for over-limit approvals, the tactic has evolved. Issuers now control the usable limit dynamically, often lowering it with little notice due to credit risk reassessment. This sudden reduction can cause the borrower's credit utilization ratio, debt to limit, to spike instantly, which in turn lowers their credit score. A lower score weakens the borrower's access to external credit, making them more dependent on the current issuer's products. Conversely, issuers use limit teasing, offering incremental credit line increases, as a behavioral nudge. Higher limits statistically correlate with higher carried balances and greater interest revenue. The limit isn't just a boundary, it's a dynamic lever that adjusts the user's financial behavior and shapes their dependency on borrowed money. Annual fees and the premium access illusion. Annual fees are sold as a cost for premium access, but are primarily designed as a predictable, guaranteed revenue stream. High fees, ranging from $50 to over $700, are justified by travel perks and rewards, which are often structured to be underused. Benefits like lounge access or travel credits frequently have restrictions or calendar limitations, ensuring most cardholders fail to redeem the full value. The annual fee creates a powerful sunk cost bias. Once paid, consumers feel obligated to use the card more often to make it worth it, thereby increasing the issuer's revenue through transaction fees and potential interest. Issuers reinforce this loyalty by offering periodic retention offers or bonus points to customers who threaten to cancel, making it feel like a reward for continued commitment. Even when the fee is waived for the first year or bundled through a co-branded partnership, the cost remains, often disguised or deferred. The annual fee is essentially a loyalty toll engineered to make you a committed, high-value debtor. Add-on products, data monetization, and algorithmic pricing. The credit card industry profits from your behavior, not just your borrowing. This starts with add-on products like payment insurance or identity theft coverage. These are often low-value, high-profit micro-subscriptions with minuscule claim rates. Beyond these fees, the modern card business is a data business. Issuers collect and sell anonymized transaction histories, what you buy, where and when, to advertisers and data brokers. This surveillance economy turns your personal financial habits into predictive profiles. Layered on top is algorithmic pricing. Machine learning models continuously assess the profit potential of each customer, dynamically adjusting interest rates and limits. This means two people with identical balances might pay different rates based purely on the algorithm's prediction of who is less likely to notice or switch providers. It is personalized extraction at scale. The revolving debt economy. All the mechanisms discussed, fees, compounding interest, data monetization, and payment design, converge into the single goal of the revolving debt economy. This quiet machine is engineered to keep balances alive indefinitely. Low minimum payments ensure continuous flow. Grace periods vanish when balances persist, and rewards encourage continual usage. The system aims to keep users optimally indebted, neither insolvent nor debt-free, but perfectly balanced for maximum profitability. At a systemic level, this is a multi-billion-dollar economy. Issuers package the recurring interest streams into securitized assets, consumer debt bonds that are sold to investors. The banks profit at both ends, earning interest from the user and underwriting/trading the bonds based on the user's predictable repayment. Regulation rarely dismantles the core model. Instead, it forces the industry to adapt and redirect its engineering toward new income channels. The ultimate function of the system is to transform your financial activity into predictable yield, keeping you in motion rather than setting you free.